The shock is spreading. Geopolitics will amplify it. Yields are rising everywhere. The balance is fragile. The shock is global. Contagion risk is high. Investors reposition globally.
ツマンおじ今日のニュースを読みます。Reuters Global bond market shaken by Japan sell-off, Greenland worries. By Alon John, January 21, 2026. Summary: Japanese bond sell-off spills off globally. Long-dated U.S. yields post biggest two-day rise since May. Greenland tensions add pressure on European defense spending. London, New York, January 20th. Reuters. A jump in Japan's borrowing costs to all-time highs rippled through the major bond markets on Tuesday, colliding with the fresh anxiety of tensions related to Greenland and underscoring investors' sensitivity to rising fiscal pressures and heavy debt load. Japanese 10-year government bond yields surged almost 19 basis points (bps) in 2 days, the sharpest rise since 2022, while 30-year yields posted their biggest daily jump since 2003, as investors braced for increased government spending. Prime Minister Sanae Takaichi called a snap election on Monday and is running on a platform of stimulus. If there is a strong demand, if there is a strong mandate following the election, that could open the door to more fiscal spending, said Shima Shah, the chief global strategist at Principal Asset Management. It puts a lot of global bonds market into a typical story about that, and you can see that in the rise in borrowing cost. Worries of Greenland, threat of more tariffs. Bond investors were also grappling with U.S. President Donald Trump's tariff threat against European allies of Greenland, which may raise the expectations that Europe will have to ramp up defense spending further through the even more bond issuance. Talk of a sell American trade has also resurfaced, adding to a selling pressure on treasuries. The benchmark 10-year yields on Tuesday hit its highest since late August of 4.313%. Danish pension fund Academica Pension said in Tuesday it was planning to sell its U.S. Treasury holdings by the end of the month, worth some $100 million. U.S. 3-year Treasury yields jumped around 8 basis points to 4.91% as U.S. market reopened after Monday holiday. Over the last 2 trading days, they have risen by 13 bps, their biggest 2-day increase since last May, when China-US trade tension flared. The spread between U.S. 2 years and 30 years yield, a barometer of investor unease about long-term government finances, was on track for its biggest one-day widening since August, yet remained well below the 19 pp jump recorded during the last April's Liberation Day sell-off. Japan fiscal pressures are concerning, but markets have become more sanguine about U.S. deficits, wrote Gennady Goldberg, head of U.S. rate strategy at TD Securities, in research note. While Japanese worry about continue to pass through the given global correlations, the U.S. Treasury is doing everything in their power to avoid overissuing long-end debt by keeping insurance shorter dated. What happened to the calm? The bond sell-off ends weeks of relative stability in big markets outside of Japan that have faced pressure over the past year from the concern about high debt. German 30-year bonds climbed as much as 6 bps to 3.53%, and the highest in about 2 weeks, before coming down to 3.483%. UK 30-year yields, which often rise and fall more than peers, were up around 6 bps at 5.22%, posting their largest daily increase since early January. In Europe, tensions over Greenland only highlighted spending pressures, analysis said. It again means Europe needs to do more on defense, said Barclays head of Euro rates strategy Rowan Khanna, which the market is going to say, look, it eventually means more issuance and more debt supply and hence weaker long-end bonds. He added the tariff will hurt growth, which was supportive for shorter dated bond. European bond market were also sensitive to the JGB sell-off because Japanese investors, the big buyer of foreign bonds, might be tempted to move money into higher Japanese bond yield. The question is where those flow going to come from now. Are they going to come more from the US or more from Europe? And given the current geopolitical landscape, that could amplify the spillover to the US a bit more, said ING senior rate strategist Michelle Tucker. You could argue it's safer to stay in German Bund than US Treasuries. 以上です。